money to the US government or to a brand new startup tech company, for instance, right, you might want a little bit more return for your investment in that startup company as compared to the US government. Afternoon, we got consumer sentiment, housing data, and the news of the US credit rating downgrade and what all of this means to cover here this week. My name is Brandon Steele, financial advisor with Mainsail Financial Group, where we aim to leave you feeling more empowered after every interaction. And our goal here in these weekly updates is to kind of break through the noise, share some of the data that we're watching here in the markets. And again, there's a couple things to cover on the data front, but most of our conversation today is actually going to be around the downgrade of the US credit rating and what that kind of means, has meant, and could mean moving forward. Before we get there, though, we do have a consumer sentiment data that came out last Friday. So last Friday, again, consumer sentiment came out, it was down again from the prior period. Probably not much of a surprise. This seems to be the trend for sure, given all the uncertainty and tariffs and you name it. I will point out, if it helps again, just to keep in mind, the last Fed press conference, he had kind of shared that although these data points are important to watch, maybe give us an idea of what the consumer, us, are thinking, that they don't always translate or correlate directly with market data. So we'll continue to watch that. We also had U.S. Leading economic indicators come out on Monday. Those are down down 1%, excuse me, versus the expectations were 0.9%. So a little bit above expectations for that. And then we also had existing home sales come out today at 4 million, again, slightly below expectations, which may be a good segue into our question of the week from Janet about what this US credit rating means. So we'll come back to that here in just a second, but obviously with higher rates can impact home sales as well. Coming up next week, just as a heads up before we step into the question of the week, we have markets closed on Monday for the holiday, so be aware of that. We do have a short week in trading there next week. And then we have the Fed minutes and the first GDP revision all next week. So first GDP revision will be important to watch given the negative print there that came out. And of course, the Fed minutes is becoming more and more important, especially with this US credit rating downgrade. So let's talk a little bit about that. Now, if you saw the news, the headline version of this is that the US credit rating was downgraded from AAA, just kind of a notch down. So, it's still a very great credit rating, but of course, it's not a good thing necessarily to see that credit rating be downgraded. What I will share is that although that's the case, keep in mind that regardless of payment issues that we could ever experience here in the US, just keep in mind that the likelihood of the US defaulting is very, very, very minimal. I'm not trying to paint a rosy picture as if this could never happen, but in present day, that chance is very small. For those who have been following the markets for a while, you may remember not too long ago, there was this concern about Greece defaulting a few years back. That was, excuse me, let me be clear, a true risk, right? That really was something that could happen. And in the present day, again, the chance of the US defaulting is very minimal. Something to keep an eye on, don't get me wrong, but this credit rating doesn't necessarily mean, the US is going to default on their payments, but ultimately that's what credit ratings suggest, right? It is the likelihood of that entity, in this case, the US government, paying their debts or defaulting on them. So again, keep that in mind as we talk through this. To say that this means we're in trouble is a different story. I mean, the reality is there's a number of tools that could be used if it came to that. But I think part of this is with higher rates, that's probably part of what we're seeing, as well as all the craziness so far this year and just the uncertainty. But generally, that uncertainty shouldn't affect the credit rating too much in the short run. So again, probably more so based on just kind of general obligations and how the higher interest rates have affected those payments. Now, what I do want to talk about is how that translated to markets, and then also how that might translate to us going back to the consumer. So first thing I'll point out is that we saw a spike in Treasury yields as a result of the news. The reason for this is, as you might imagine, if the US government is less likely to pay their debts, investors in bonds, right, might require more of a yield, in other words, interest payment, in the meantime to loan the US government money. Now, again, this slight step may not make that much of a difference. But at the end of the day, that's how these credit ratings work, right? If you're going to give money to the US government or to a brand new startup tech company, for instance, right, you might want a little bit more return for your investment in that startup company as compared to the US government. Don't laugh. I realize that there, maybe there's some jokes within there as well. But generally, that's how it works, right? So keep that in mind. We saw 10-year Treasury yield spike as a result of the news. Likely, we could see higher rates for longer is maybe the short version of this. Now, this will all translate to the Fed, which is why I brought that up earlier. We'll see what they share on Wednesday as well, because there are a number of things that affect yields. And there's a great follow-up from last week. We talked a lot about that. So if you didn't see last week's update, definitely tune in to last Thursday's market update. If you just kind of follow the page, you should be able to see it there, where we talked a lot about yields and what's been going on this year. And this is another component that can drive yields as well, although not something we've really dealt with recently. So definitely something to keep an eye on. Now, what this means as far as to us as consumers is keep in mind that interest rates that we pay for mortgages, credit cards, et cetera, are generally based on these longer term yields, not necessarily what the Fed does, although that can impact longer term yields, right? So just be prepared. That may mean rates stay higher for longer now as well. For the most part, I think, except the bond market, the stock market seem to kind of shrug this off. But to keep that in mind, if this kind of continues to be the theme, we could see yields higher for longer. Now, if the Fed decides to start cutting, maybe that takes a little bit of pressure off of things. But again, the Fed cutting is not the only thing that affects longer term Treasury yields, like a 10-year bond, for instance. And so even as a result, it doesn't necessarily mean we'll see the 10-year Treasury, let's call it bonds, or things like mortgages and credit cards, et cetera, follow suit. So hopefully that was helpful. I thought this was a really great question of the week here from Janet, and very timely, obviously. Great follow-up to last week's session. So again, if you didn't see last Thursday's market update, maybe take a look at that for kind of an update on where yields have been through the year. We will look forward to seeing you here next Thursday. Again, next Thursday, we have the Fed minutes and the GDP revision. But remember, it is a shorter week. So for everybody out there, enjoy your Memorial Day weekend. And we will see you next Thursday at 3.